right, let's talk about taxes and being able to deduct taxes. The bad news is income tax, federal income tax, is not a deduction for you. You can't do anything with that. State taxes are, and some other taxes that we're going to look at right now. All right, so when we're talking about taxes, taxes are tax deductible. State and local income tax. These are often called SALT, S-A-L-T, state and local tax. So we're talking about your income tax from the state or local situation, cities. Texas, we don't have this, so we don't really worry about income tax here. Property taxes, oh yeah, Texas is killing us on the property taxes. So that is a deduction for you. Sales taxes, this one's a relatively new one. You can deduct sales tax. Now, this doesn't mean you have to save every receipt you get from Walmart for everything you buy. The IRS will give you a number that you can look up. Now, there is an either or with this. You can either deduct sales tax or you can deduct your state and local income tax. Well, since Texas doesn't have a state and local income tax, what do you think all the Texans deduct? We deduct the sales taxes. So like I said, there's a table that we use to find out how much we can deduct, and that's the easiest way. Or you can absolutely add up every little every little piece of sales tax you paid during the year and deduct that actual expense. But now you got to remember, this is all subject to audit. Any number you put on a tax return is subject to an audit. So if you pull up a sales tax number that's not given to you by the IRS, you're going to have to be able to back that up in case of an audit. So I tell most people just to use the table number. But the table method, you are allowed to add large purchases, things that aren't generally purchased every year, like a car or a home or things of that nature, even like refrigerator or something. So we could take the number from the table plus the amount paid for your new car, because taxes on a new car are often around $2,000 or so. So you can add that $2,000 to the number you're getting from the table. Pre-2018, there was no limit on the amount of state and local taxes you could deduct, but now it is capped at $10,000. I do want to point out that if you deduct these taxes somewhere else on a Schedule C, E, or F, it's not part of this limit. It's not an itemized deduction, and you would absolutely want to deduct any of these taxes, property taxes, on one of these other forms first. So if you have a rental property and you pay $5,000 of property taxes, you don't even want to think about trying to itemize this property tax as an itemized deduction. You want to deduct that property tax on your Schedule E. Same thing with the Schedule C, business personal property. You have to pay property taxes on the desks and computers and copiers that you have in your office. And so you don't want to deduct that on your itemized Schedule A, you want to deduct it on a Schedule C. Income and sales tax, both income taxes and sales taxes are deductible like we discussed. You got to choose which one you want to go with. Sales tax benefits people in states without income taxes very easily. The income taxes in some states are extremely high, like California and New York are extremely high and can really be much more beneficial than the sales tax. You can deduct the income tax amount that withheld from your paycheck and amounts paid during the year or prior year your ES payments. So if you're paying into Oklahoma estimated taxes, you can count that as your income taxes. If you get a refund, you do have to do some work to kind of figure out how much of it was income. So maybe you claimed $5,000 of income tax that you paid in via estimated tax payments, but you got $1,000 refund. Well, you deducted $5,000, but you got $1,000 back. So you're going to have to pick up that $1,000 as refund in the next year. Sales taxes, again, this is where we were talking about that table. So here's an example of the table. You go by your family size and then what your income threshold is. So if you have and they give you a state. So here's Texas. We're looking at Texas. You have a family of, say, 4 people, and you're making $100,000 a year. So we would go over here, and that's $1,136. So that's the amount they would give you as a deduction. Now, the one thing they don't tell you, if you notice, they're using 6.25%. That's because that is the state in sales tax rate. We have a local rate, and for pretty much every city in Texas, it's 2%. So really, you can add in that extra 2% number here, and most tax software has a way to work that out for you, and that'll add that to your $1,136. So somebody here in Grayson County, they would get to deduct more than $1,136 because we're only looking at 6.25%. And then, like we talked about, if you add on any ticket for add on any sales tax paid for big ticket items like your auto, boat, RVs, etc., and don't forget to add the local rate. So taxes are one of the big three when it comes to itemized deductions. Most people who itemize are able to do so because of three special deductions. I shouldn't say special. There are three itemized deductions that are very common and that most people have. And when these three items are greater than their standard deduction, they itemize. So the big three to me are property taxes or state and local income taxes, but we're in Texas, so I always think property taxes, mortgage interest, and charitable contributions. Those are the big three right there. Most people itemize because these three items equal more than the standard deduction. So we just talked about state and local income taxes, state and local property taxes, sales taxes. So that's the first one of the big three. Coming up next, we're going to talk about mortgage interest, which is the second one the second of the big three.